Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carpino and Jack Forehand are principals at Lydia Capital Management. Matt Ziegler is managing director at Sunpointe Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Lydia Capital or Sunpointe Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Lydia Capital or Sunpointe Investment.
All right, guys, in our never-ending quest to talk about all different types of financial planning topics, today we are going to talk about Roth IRAs and specifically Roth or IRA conversions. And we're happy to have Ben back on the podcast, who's Matt's colleague at Sunpointe, to tackle this issue with us. So we're going to talk about the strategies around Roth IRA conversions, when they may make sense for people, some of the, many of the pluses and some of the also considerations that people would want to be thinking about when considering this. And then I think, kind of looking at this from a planning and, strategic perspective for investors. So that's the topic for today. This can go pretty deep in the weeds. I think we're going to kind of stay maybe a little bit above the fold, but I think this will be a good discussion in terms of helping people sort of think through, when a Roth IRA conversion makes sense. But to start, let me just put this out there to sort of set the stage. Let's sort of talk about what are the main advantages of Roth IRA versus the traditional IRA.
So let's just say this first. This is always a conversation about tax now versus tax later. The advantage of all retirement accounts is that once the money's inside the account, it's going to compound without an annual tax liability. So if you have earnings, you have dividends, you have interest, you're not creating a tax liability once it's in the wrapper. I like to think of it as like you've thrown the money over this wall. And so long as it's on the other side of the wall, the IRS is like, you're cool. You don't owe anything. When you pull it back over, though, that's when stuff can become an issue, or sometimes the act of throwing it over. So if I don't pay any tax when I receive it, it goes directly over the wall. That's a traditional IRA, 401k, traditional plans. It's deductible when I receive the income and put it aside. Because it's deductible when I put it aside, I'm going to pay tax when I pull it back out. The flip of that, the Roth option, is basically I pay the tax now, put it aside, and it's going to come out free of tax later because I paid the tax liability now. Both cases, I get the income tax deduction now, I sock it aside, it gets tax deferred growth, I pull it out later, I pay tax on a bigger amount, or I get it now, Roth, pay the tax at my income tax rate today, set it aside, let the tax deferred growth happen, then pull it out tax free. That's pretty much all we're ever talking about. I'm going to kick this to Ben in just a second on this too, but I'm going to invoke a song right at the beginning. Taxman, the Beatles, prefer the Stevie Ray Vaughan version, but they're all good. But my advice for those who die, declare the pennies on your eyes. Great, great, great line. Remember with this too, when we're talking IRA, we're talking Roth. There's the while you're working phase. When you have income coming in, there's the while you're retired phase, or if you've stopped working. And then there's the why you're dead phase. And we can't talk about these strategies without talking about those three phases. Are you working and getting income? Are you not working and taking income? And are you dead? And what happens with the money? Ben, additional comments on just traditional versus Roth and why these things exist?
So from the tax is the biggest conversation piece. It typically always is. Tax now versus tax later, as you just said. The no RMDs for Roth is the other attractive component. And we have to remember, I know we covered this in a previous episode, was around some of the new legislation with the 10-year rule being implemented for inheriting a traditional IRA. Now, those same rules apply to a Roth IRA. But if I inherit a Roth, I'm taking the money out tax-free. If I'm inheriting a traditional IRA, I still owe taxes. So there may be implications for your beneficiaries. And that's where, Roth can oftentimes be more attractive.
So I think this is going to come back to tax now versus tax later again, but can you just talk about at a high level why someone would convert a traditional IRA to a Roth?
Tax now versus tax later. Again, these three phases are really important, and I think get left, maybe not left out of this conversation, but they belong in it. If I'm thinking about converting a traditional to a Roth, so I've already basically gotten the tax deduction, and now I'm saying I want to actually flip this, so I want to pay tax now so that I don't have to pay tax later, then I probably need to know my tax rate today versus what I think my tax rate's going to be in the future, which you don't know unless you have that crystal ball, in which case, good for you, please share. But the rest of us have no friggin' clue. And that turns it back into those three phases again. So it's like, what's the answer while I'm working if I'm going to convert this to when I think I'm going to need it later? Am I doing this to a Roth because I want it to go to my beneficiaries, phase 3, while you're dead? While you're working, while you're retired, while you're dead. That's all we can deal with here. So if I'm going to convert this, what's my tax rate in those three phases? Tax rate while I'm working, tax rate while I'm retired, tax rate while I'm dead, and all the in-betweens. The math on this is don't do it by yourself. Don't do this at home, kids. Don't do the math on Roth conversion without consulting some professionals. Ben, do you want to comment on, we see this all the time. We think about this all the time, and yet we do it very rarely.
That's the thing is, it's talked about often. I haven't been a part of enough of the times where we've actually pulled the trigger. We just did it this week, actually. A client of ours who is late stages of life and has a large traditional IRA, and the beneficiaries are both in a high tax bracket. So the planning phase there is less than 3 years to live. You're in extremely low tax bracket. Again, I know that this comes off a little bit insensitive because we're talking about late stages of life and trying to capitalize on a low tax rate, but it is part of the planning conversation overall and how we can save as much money as possible for the beneficiaries. So know that there is some sensitive component to this conversation, but that was an opportunity where we could say, hey, let's pull some of these dollars out now. Let's pay tax on it at this 12% rate. And let's see what next year holds. So we're doing it on more of a tactical basis for many clients. If you're in those working years, as Matt said, especially if you're in your prime working years, you probably are finding yourself in a high tax bracket, not favorable to be doing the conversion at that point. So being somewhat tactical on low income years is an area where, we can certainly add a ton of value.
And don't overlook those phase transitions, because while I'm working to while I'm retired, sometimes there's a bunch of chapters in the middle of like I've stepped down my hours before I've officially retired. Sometimes while retired before the while dead phase, I'm thinking of The Princess Bride. I'm thinking of him on the table and being like, he's not dead yet. Like there's these transitions, and the planning that can happen in those transitions for those meat of those phases is real too. All about if you know what you want to do. If you know what you want to do, people like us can help you run the tax analysis on what this might mean in some different scenarios, how it can play out.
One other thing I'll add here too is we do the planning, we do the forecasting, we do a lot of the calculations. We do not commit to this until we get the final stamp of approval from the most important person, that is the accountant. That is to make sure that we have all of the signatures that we want on that page to say, have we thought through all of the scenarios? We'll talk about it a little bit later. Matt just touched on the phases of life. Remember, once you get into the Medicare situation and you're on Medicare, Part B and Part D premiums are adjusted when you have too much income. You have additional premiums there. So there's additional layers that you need to consider outside of just taxes. I wanted to make sure that we said we are communicating with clients' accountants to make sure that we're all on the same page before we do this, and there's no surprises when it comes time to file taxes.
So you guys sort of answered my next question, because when we talk about these things on the podcast, some of the things we talk about in financial planning are things that in the real world are used all the time, and some of them are very rare. And I would have guessed coming into this that this is something that's done pretty frequently, but the answer is that's not the case, right? This is something when you look at it, you end up not doing most of the time.
People talk about it all the time. Like you'd look on social media and think of everybody as just converting Roths all day long. It's like, no, most of the time, I would say it's probably like, do you remember under the, great financial crisis under Obama, we had that big rule change where you could spread out the conversion over a couple of year period. Do you guys remember this at all? Did this affect your lives?
Yes.
It didn't affect my life. You guys aren't going to want to hear this, but I was in high school.
So when Ben was in high school, pre-employment, he was taking that newspaper money and he was doing Roth conversions every year to max. No, like even in that case, so that was a big deal with how many people wanted to talk about it. And being an active financial planner, like in that period, I can't tell you, like I must have run 20 or 30 like in-depth complicated analyses with new tools that would help us do this and think about it over a multi-year period. All those scenarios, I think I did like 2 partial Roth conversions for people. They're important to look at. And there's a lot of like immediate dependent issues when they can make sense. A lot of them have to do with those like middle chapters to the phase transitions. Before somebody dies, you know they're sick and you know the kids are getting the money and you just go, mom or dad or either or both, 12% tax bracket. Kids are at 40% tax bracket. We really want this money to help them. That's when this conversation becomes real and there can be a stated purpose in doing it because we have clarity around the tax arbitrage. But knowing like what your tax rate's going to be in 30 years and stuff like that, sometimes it's just, you got to split the difference and take the most comfortable bet. You do the math, you look at the numbers, you see what it's worth it. It's just not that often that it actually is.
Ben covered some of this already with the idea of Medicare, but is this really just purely a tax thing? I mean, are there anything other than current tax rate, future tax rate that weighs in on this decision?
Medicare is a big one. I think that's probably it's not talked about enough because the acronym is IRMA, Income Related Monthly Adjustment Amount. So what happens is when you breach certain thresholds, similar to your tax buckets, once you fill up the 10% bucket, you're going to move to the 12% bucket. Similar to that thought process, when you're on Medicare, you have an adjustment, a premium adjustment. Once you go to breach a certain threshold of income, you get, maybe it's $150 a month additional on your Part B benefit and your Part D. So you have to start to factor that in. Maybe the conversion is going to cost $8,000, $10,000 in taxes, but that IRMA adjustment on Medicare could cost them $4,000 over the next 2 years because it's a 2-year look back period. So you have to add those two numbers together to say, this is the total cost or the total overall tax for what this is going to, what this impact is going to be. And for the scenario we just did this week, that's why we opted to do a bigger conversion to say IRMA would have a like 3.5 or 4% impact of the total tax. Was way too large for what we were willing to accept. But if it was really only going to have, a 1.5% if we actually increase that number 3x. So that's where thinking through it with the accountant is really helpful to bounce some ideas back and forth off each other to think through these scenarios.
Yeah, and I would think the other issue here is the uncertainty with respect to the tax code itself. I mean, I can obviously look at the current tax brackets and say, if they hold, here's what I think my tax rate in the future is, and here's the current one. But who knows? Who knows what administration is going to be in there? Who knows what's going on with the deficit? I mean, all that stuff. I mean, it's probably very hard to figure out like what a tax rate 20 years or 10 years or whatever it is in the future might be.
Think about where we are today. We don't even not even 20 years out. 2026, we have a sunset of the tax code. So we're talking about just 3 years trying to figure out what's going to happen, let alone 20 years. That's an impossible guess. This is another, we think about multiple times to do some of these conversions for the right client. It is pre-2026 because tax brackets adjust back upwards if Congress doesn't step in. So there is another impact, and there is, a timetable to this, to knowing some of those pieces of legislation.
Yeah, I was thinking through like scenarios where this might work before we did this. And I realized I might have made a mistake like with my parents because they retired and they were funding themselves out of a taxable account for a while. They didn't have Social Security yet, and they weren't taking any money out of their IRAs. And, I think you have a certain period, with the deductions that are available, you can take a certain amount of income with no tax. So is that like a type of period I probably should have been doing Roth conversions?
Maybe yes, maybe no. There's obviously unlimited factors. I wouldn't know the specifics of the situation, but all Roth is also not the answer either for many clients, because you're in a really low tax bracket. If you're all Roth, that means you already paid taxes above where you are today if you're in a 0% tax situation. And remember, you always have a standard deduction to lean on. And later in life, you typically have some slight increases there. So if you're not actually using your full standard deduction, you probably converted at a bad time. You paid taxes too far in advance when you could have waited to do some of that stuff or take money out of a traditional IRA that would ultimately still be tax-free because of that standard deduction. So maybe yes, maybe no, to answer your question.
I want to ask, I remember with this stuff, when I took the CFP exam, there was this 5-year rule that exists. Can you just talk about what that is? Is that relevant to what we're talking about here?
Absolutely is relevant, because if there is so the 5-year rule states the Roth to pull the money out tax and penalty free needs to have existed for 5 years. And that's the key word, existed. It's not like you have to be funding for 5 years. That's not true. It just needs to be open. So if you don't have a Roth today and you want to do a Roth conversion, obviously you need to open a Roth. But that 5-year clock starts when you opened the Roth. What would be more beneficial is for everybody to go open a Roth IRA today, put $5 in it, whatever the minimum is for the custodian that you're working with, and get that 5-year clock started as soon as possible. And it's just one Roth. It's not on an individual 5-year basis. It's just as soon as you have one Roth open, the 5-year clock starts. Once that expires, you have satisfied the 5-year rule.
And how do you think about timing on these? Like, I saw an example when I was researching this. Like, a lot of times people do these at the end of the year, but if you assume the market's going up, you could have had tax-free growth in the money if you did it throughout the year. Like, how do you think through that?
Think about it the same way as investing. What would be the best day you would tell a client to put the money in the market?
Today.
Exactly. So you have no idea what tomorrow holds. And for many on the investment side, they would dollar cost average. I'm not sure what tomorrow's going to hold. So why don't I put in $100 or $1,000, whatever it is, each month and just have it automated? Perfect. This way it takes some of the emotion out. This conversion conversation can very much be the same thing. Because if you convert early in the year, let's say you convert $10,000 and the market drops 20%. Well, you paid tax on an additional 20% that you didn't need to. But obviously you didn't know the market was going to go down. But conversion cost averaging can help you mitigate some of that risk. Now, the data says in a 12-month period, the odds of the market going up is roughly 75%. So converting sooner rather than later typically is going to have a benefit. So you could do a average basis, or you could do what's called a barbell. You could do some at the beginning of the year. Let's see how the income and deductions play out. That's that middle part. We're going to do no conversions. And that at the end of the year, we're going to do another conversion based on the income on the year and the deductions. And that is how you can use the calendar to your advantage.
Yes, this really gets back. And Matt, I know you're a fan of Nick Majouli's work around this dollar cost averaging. I mean, this really comes back to the overall dollar cost averaging discussion, which is, in general, if you have money to put in the market, you're better off putting it in the market. And now behaviorally, that may not be true, but in general, that's the way it usually works.
And to Ben's point, and definitely to Nick's point, one of my favorite posts on this, and I'm sure we can link to it or you can look it up. It's like if your tax rate stays the same, it doesn't really matter. It's just math. Like if your tax rate stays the same and your returns are the same when you put it in and when you take it out, it's a moot point. That's the way this is supposed to work. The reality, when we factor in Social Security and IRMA and all the other stuff, and depending on your situation and your needs, I would also say, just like with the market timing stuff and whatever else, don't just look at this as an investment scheme to reduce tax drag. Also look at this as like, this is your tax diversification. So like building assets in different pockets for different needs at different points in the future, especially around like tricky transitions between those phases. That's really what we're doing here. We're just building a diversified tax consequence asset base for people of all net worths too. To the case we were solving for earlier this week, to another one I have later today that's like the opposite side of the wealth spectrum. You just got to be able to weigh all these considerations.
I'm just curious at a higher level, thinking about just Roths versus traditional IRAs. I mean, in terms of an optimal way to use them, and do you guys typically see clients having both, having some money in both, since both have advantages over the others?
Yeah, the point I just made, like we like to see clients who have some Roth assets if it can make sense for them, and some traditional. The more higher earning client and the younger they are, probably the more heavily weighted at that point in life, they're going to be towards tax deferred accounts. So traditional IRAs, your deductible 401k contributions, that kind of stuff. What's interesting is then the highest earners go beyond that, and they might not be able to fully fund a Roth up to their desired potential, but that's where you end up with like the after-tax brokerage or investment accounts. And so it's just understanding this mix of which things are going to trigger income tax level consequences now versus which things aren't, and how are we going to mitigate that. In a taxable brokerage account where I'm hopefully only dealing with long-term capital gains and, net gains or incorporating losses, or in an IRA of some form, traditional IRA where I get the tax break up front, but I'll have to pay tax later at an ideally lower income tax rate, or in the Roth where I'm biting the bullet now, but in a size and scope that it actually clearly makes sense for what my consequences are later. Did I miss any of that or any other pieces to pull apart there?
No, and I know this can be like a very complex thing. When you think about taxable brokerage account, traditional IRA, Roth IRA, like getting the right mix, it's such a specific thing to every person, but can also be very complicated to try to figure all this stuff out.
There's no right mix. That's the thing is there's no right mix. You're not going to know in time. You're just going to know over time what punches you're going to have to roll with that the world's going to throw at you. But back to, and I still love it's the Mike Tyson thing. Everybody has a plan until they get punched in the mouth. And then as we so eloquently, hopefully added to the financial planning lexicon, the little max star punch. And that's really what these things represent. If you have taxable brokerage, IRA, and Roth, and all of a sudden you have to have a bill or a payment, and you have to just make sure it doesn't step on something else that you didn't anticipate going on, the little max star punch is like the secret move you can pull out of your pocket in a case like this, where clients are dealing with some medical issues and some other stuff and some other higher than added bills this year. And we looked at the math, and the clearest way to do this is to take a distribution from the Roth. That's the little max star punch. A bunch of crap happened in their lives they wanted to try to avoid, but they couldn't. And now we have to introduce a little more income to their retired situation. The most efficient way to do it is to take it out of the Roth. And it's a perfect scenario for using it because it's not going to impact some of the other benefits and things they have going forward, because these are one-time events.
Many people listening may not have IRAs. They may have 401ks. And I know we have Roth and traditional options there. So how is this discussion relevant to somebody with a 401k?
It's really similar. So the one area that kind of gets removed from the situation is the income limits that I know that we haven't really touched on. Is when you have a 401k, there is no income limit associated with contributing to a Roth 401k like there is for a Roth IRA. So that's the one distinct advantage of using that in the 401k scenario. The other big difference is, to Matt's point earlier, this gets talked about all the time online, called a mega backdoor that's associated with a 401k. It gets talked about so often that you almost look into it and you're like, why am I not doing this? Oh, that's right. Less than like 3% of servicers of 401ks allow this unique aspect to happen. So we can obviously dive into a mega backdoor. I know that we were going to go there, but that's only available in the 401k scenario where it's not available in the IRA scenario. So there are just some slight tweaks to some of that. The income limits is the major differentiator between the 401ks and IRAs for Roth versus traditional.
Plan design is so important on this. So even if you have a Roth option in your plan and you work for some Fortune 500 company, or you work for some 3-person mom and pop outfit, even just because it says you have a Roth option, you have to understand the plan design and how those rules are going to permit. It might be that like your employer match is only ever going to go into your traditional sleeve. It might be that it allows for the employer match to go into the Roth. There's lots of rules in how plans are designed and set up. They're not always current with the times. we work with third-party administrators to help retool these for clients all of the time. And in the case of stuff like the mega backdoor Roth, much like Roth conversions, we've mapped it out a million times. You might set up one every so many years when the exact perfect scenario presents itself. But for the most part, it sounds great, but it's harder or not worth executing on paper. So you might be the one person that it makes sense for, in which case it's worth exploring with someone who can help you explore it, but it's not a silver bullet.
To take it back to a much more basic level, can someone with a 401k do the same thing? Can they convert a traditional 401k to a Roth 401k?
So you would in-service, that would be an in-service conversion. It can. What happens oftentimes when you're trying to do that is what we've talked about with being tactical. My example before, you want to convert $10,000 and the market drops 20%. Well, if you have a down position in your 401k on the year, that's a great opportunity to try to get that into Roth because you owe less taxes on it. But what happens is they have an aggregation basis in 401ks. I haven't seen one that doesn't have this aggregation basis where it says, all right, I want to convert $10,000 of this specific fund. What they'll say is, no, we're going to aggregate the whole 401k together and we'll just convert $10,000. So it's just suboptimal in many scenarios when we think about the 401k conversion. It's you don't have the customized approach that you can have with an IRA.
The plan design has to allow for it. You have to talk through it. Usually, like the only times we've looked at this, it's been us as the advisor talking to the plan administrators and with the client and usually the accountant to see if it makes sense. And even then, it's usually because there's some narrow driving force. Sometimes the case is somebody is tapering down work or the work arrangement is changing. They're pre-59 and a half. As you may know, sometimes between like 55 and 59 and a half, or somebody who's over 50 sometimes is looking for ways to not take money out of the plan because of that penalty that crops up until 59 and a half, 55 in some cases. Again, why you need to ask the questions and get professional help. But this is like the reality. The in-plan conversions are there if your plan allows for it, if it has the infrastructure to do it. And even then, there are narrow circumstances where you might want to do it because of aggregation rules and other things for making this happen.
So if if they're no longer working at the place where they have the 401k, the idea would be if they ever wanted to do this, they would roll it over into a traditional IRA and then do a conversion to a Roth.
Yeah, so that's one thing we do see. And again, this can be really specific on like ages. So if you're, now I'm just thinking out loud. So Ben, catch me when I get myself into trouble here. This is why Ben's on this call as director of planning. I start to get myself into trouble and then he wheels me back and brings the adults into the room. So like you're 50 years old and you're separated from service and you have a good cash account set aside, but you realize you might need to tap retirement accounts at some point to get you to, I don't know, some trust that kicks in or some house you're going to sell or whatever next inflow you're seeing, but it doesn't happen until you're like 60. And you know, you're paying a COBRA and you're paying whatever else. So you might go, okay, I'm going to roll over my 401k. And because I'm under 59 and a half, anything I do has an additional penalty tied to it. So now I might start doing piecemeal conversions into the Roth, start my 5-year clock, and then look at ways I can ladder. Hopefully we're not getting into Roth laddering. These are all like tracking nightmares, by the way, too. Like if you want to do this, the amount of record keeping you have to do to not screw this up can totally be done. But benefits to brain damage ratio of doing this, you got to think about that too. So in this case, like I'm 50 years old, I need some more money between now and 60. I leave my job, I roll over the 401k, I start to do Roth conversions to start my 5-year clock to free up some money that's penalty free on the back end. Stuff like that can be done. Benefits to brain damage ratio, make sure it's worth it. You know, don't do it for an extra $5,000 probably unless it's make or break for your life. But it's not like you're going to be doing something to free up millions of dollars here probably.
So you guys touched on the mega backdoor, which we probably won't spend too much time on because it doesn't seem like it's something that ever really happens, but I did want to at least define the term. So it sounds like we have the backdoor Roth conversion, and then we also have the mega backdoor Roth conversion. So can you guys just define what those are?
So your backdoor Roth is, if I had to guess it's 100 to 1 or maybe 1,000 to 1 more relevant than the mega backdoor. So a backdoor Roth is, I had mentioned the income limits earlier. You earn too much money, you can't directly contribute. It's as simple as that. What has to happen then is you need to go through one additional step, which is setting up a traditional IRA, contributing the money to a traditional IRA, and then immediately converting it. So you're contributing after-tax dollars, which is non-deductible, to a traditional IRA, and immediately converting it, which is a non-taxable event. So that's a backdoor Roth. The one area that I'll point out in there that gets a little bit tricky is, Jack, in your example, you're talking about rolling over a 401k. So if I rolled over my 401k into an IRA, traditional IRA, it's $100,000, we'll say, and I want to add $6,000 to that and then do the backdoor. The IRS steps in and says, there's another aggregation rule. 6,000 divided by now 106,000 is the tax-free portion. Be around, 5%. 5% of your $6,000 conversion is tax-free. The other 95% is taxable because we have to aggregate all of your pre-tax IRAs into one. That's where it starts to get really tricky. So if you have other existing dollars in an IRA, traditional IRA or a rollover IRA, many times it doesn't make sense. Matt talked about benefits to brain damage. That is so complex when we get into that then we want to start just thinking about a traditional conversion or just doing a non-deductible contribution to an IRA and keeping track of it on your tax forms, Form 8606. So that's how we, when we're thinking through that backdoor, it's best to do it if you have no traditional IRAs. Now, the one last wrinkle I'll throw in this, it's the traditional IRA balance at the end of the year. So another example, I did that rollover, but I want to roll that 100,000 back into my new 401k. I want to roll it to the new company I'm going to. I left Vanguard, rolled it over to an IRA. I joined Sunpointe. I have a 401k here. I'm going to roll that into my Sunpointe 401k. Well, if that was done in September, at the end of the year, December 31st, all that was in my traditional IRA was my $6,000 that I contributed. Now I can do the backdoor Roth without having to do the aggregation rules. So there are ways to think through this and, benefits to working with a planner to say, hey, let's actually move that back over because this benefit to you is really important. It's going to save you a lot of money in the future. So let's do that. So that's the backdoor conversion. Matt, anything else that I missed there?
I think something that comes up a lot, Ben, as a financial planner, are there any income income limits tied to me making this backdoor Roth conversation? And why do they call it backdoor? It sounds so shady.
Because you can't do it through the front door. The question that we get most is, why would the IRS not just let anybody contribute to a Roth? Well, they add this extra step to start to deter people, and they add the aggregation rule to really deter people that have lots of money in these pre-tax accounts. And there are some major benefits to doing it. That's part of working with professional and thinking through this.
And limits to income, or can anybody do a backdoor Roth contribution if they know what they're doing?
I missed that part of it. Anybody could do a Roth, backdoor Roth.
And so you guys talk with standard conversions that we talk a lot about this, but we don't do it that often. Is that true too with these backdoor Roth conversions, or do you do these more?
I think this is probably 100 or 1,000 to 1, the mega backdoor situation, which I know we're going to dive into in a second, but this is much more common in the real world than the mega backdoor situation.
So we won't spend too much time on the mega backdoor, but can you at least define what it is?
Yeah. So section 415 of the IRS code says that you can contribute for 2023. If you're under 50, you can contribute $66,000 total to a 401k. You can do $22,500 yourself. Your employer could do that remainder. I don't know a lot of employers out there that are going to say, oh, let me make up that entire gap for you and, give you an extra $40,000 in your 401k. Maybe they'll give you $10,000. So if we say 66, we'll take out, you're maxing out your 401k with the 22,500. Your employer is going to give you another 10,000, 32,500. That leaves us $33,500 available to go into a 401k. If your plan allows you, you contribute after tax money, non-deductible, synonymous here with Roth, into your 401k as that other limit allows, 33,500, and then you do an in-service distribution to a Roth IRA. So now what you did was you contributed $33,500 to a Roth IRA this year, which is much higher than the IRS allows you to just contribute, on your own to opening up a Roth IRA. So that's that mega backdoor that everybody loves to talk about, but it has to fit such a finite path. The plan provider has to allow it. It has to be part of the service agreement. You also need to have an additional $33,500 that you're going to be putting in there after you already contributed $22,500. You have to max out the 401k to even make this make any sense. So there's a finite amount of folks that this is appropriate for and available for that matter.
If you run a small business, if you're a very high earner, if you're a solo entrepreneur and you're a very high earner, these things can be mapped out, and people can help you weigh the benefits and the pros and cons of this. That's the only scenario I've seen it work out. And it also takes that person, let's say it's like a solopreneur, that person has to also say like, I'm willing to pay. You're paying tax on it now. So if you're making $1 million this year and it's just your solo consulting business and you want to set up a mega backdoor Roth and do it because you have control over these things, to Ben's point, you're going to lay out that, what was the limit? $60,000 this year?
66.
Okay. So great. $66,000. You're paying top boat tax rates on that. And if you're a solopreneur and have your own business and maybe you're as an S corp and you're going to pay it out as a dividend at 15%, like, are you sure you want to pay that high of a tax rate and introduce that much tax drag? And that's a big part of the reason why, even if you can jump through all these hoops, it doesn't mean you always are, because sometimes there's a better in the moment reality to deal with to reduce some of that tax drag.
And wasn't there something in proposed legislation that would affect either this backdoor or the mega backdoor? Like, weren't they trying to get rid of it?
Yeah. I mean, if you think about, they put income limits on the Roth IRA. What they're trying to do is, to Matt's point exactly, is your average person going to be able to do this mega backdoor? The answer is no. Like, how many people max out their 401k every year? It's a really small crowd. You have to have income high enough to make it make sense. So they did propose legislation as of today. It is still allowable in the right plan.
There was just one other thing I want to bring up before we close out is Matt brought this up in the pre-call, but this idea of a recharacterization versus a conversion. So let's just say, as an example, I've contributed to my Roth IRA, and let's say as an example that the $300 a month we're generating in YouTube revenue blows up because we get 50 million subscribers, and now I make millions of dollars between now and the end of the year, which I think is highly likely. If that happens, now I am now over the limit for contributing to the Roth. So how does that work?
Yes, they're going to say, hey, Jack, you got to get that money out of there, right? So what you need to do is recharacterize it. And there's, a whole host of things that are introduced here. If you're contributing every month, that money is earning money. So, wait, you shouldn't have had that in there in the first place. So you have to recharacterize it. You have to pull it back out and put it into a traditional IRA. So like, that's the most common scenario is you pull out the Roth IRA dollars back into a traditional on a non-deductible basis, which, as we covered before, you could have just done a backdoor Roth in that scenario. So it's really just pulling the money back out of a Roth IRA that you weren't allowed to directly contribute in the first place at a high level.
To be aware of when you have steep changes. And whereas I'm not saying it's less likely that we get 50 million or 500 million YouTube subscribers in the next, however many days are left in the year, the 90 or so days we have left in the year. But a place where I have seen people stub their toe on this is like kids who are in college and going into their first job. So it's like summer job, contributing to a Roth, do whatever else. And like kids going to work in the tech sector in some high growth thing, or sells a company or something silly happens. And was doing the Ben's point exactly, like the monthly Roth contributions that now have earnings. I saw that with somebody at the beginning of the pandemic. It was a giant pain in the butt to back it out, recharacterize what you could do, and man, backing out the earnings and figuring out what should and shouldn't be in there. It just sucks. Like do it on purpose with intention, knowing fully what you're doing. Because when it gets messed up, it's an administrative headache.
So it seems to me, Matt, like you're suggesting that this episode will not be the starting point of our path to 50 million subscribers by the end of the year.
This is our path to 500 million subscribers by the end of the year.
Is there anything else we missed? Like anything else you guys think about from a planning perspective as it relates to Roth conversions and everything we talked about?
I want to just bring up that it's so important. Think of them as their own separate like assets. So just like you have asset diversification, this is part of the asset location diversification. We have a whole episode on asset location, and allocation and location are two different things. But what you're doing is you're creating, like when you have Roth assets, just like if you have after-tax investments and pre-tax investments, retirement accounts, you've got all these different things to pull on to convert assets into income in your budget in any given year to deal with things you want to do or things you don't want to do. So whether it's buying that second or third home or that vacation property or taking the family on a vacation, whatever it is, or it's dealing with the, oh crap, like we have to replace the roof or we have to do something that I don't want to pay for. Asset location says we have flexibility in the moment to manage around all the other stuff, not screw up Medicare maybe in one hand, or get as much gift as possible to the next generation in the other extreme. It's a planning tool. Tax location is as important as asset allocation when it comes down to flexibility. And that's really what the message is here. This is one tool, but it adds enormous flexibility when it's in your toolbox.
Yeah. And just to, I guess, piggyback on that, don't forget, like, Roth IRAs are kind of relatively new in this country. So I think we're going to be seeing, as time goes on, more and more people have the ability to contribute to a Roth 401k, 529 plans, money can be ported over into Roth. So I think hopefully the big sort of takeaway here, while we started the conversation around conversions, where we're kind of ending is that, knowing what your Roth IRA options are and being educated around these vehicles and knowing how to get exposure to them, I think is very important for investors. And I think it's going to be even more important, because these options are now, here and available to us. The only other thing I was going to say, it's funny, I was talking to a investor recently, and he has a couple $1 million in traditional IRAs. And so he is turning 73 next year. And so the RMDs are going to kick in for him. And, he's able to meet basically all his expenses now with his Social Security. He has a pension, and what he's really concerned about is this huge tax bill that's going to, for him at least, going to be due because he's taking the RMDs. And so it just got me thinking, like, for a guy like that, and again, like you guys have pointed out, every situation is different and stuff, but if he would have, maybe converted at some point, that tax liability on the RMDs, would potentially be a lot lower than he's being forced to take. Anyways, just an example of someone I was talking to recently that I kind of was thinking about that as you guys were talking about this stuff.
And there's so many of these where you just want to be aware of it so you can plan for it in the moment, and stuff changes. Clients who, they one of the spouses passed away, and we were doing this process and had mapped it all out, but then one of the spouses passed away, and we had to rethink the strategy when the tax bracket changed on what they were doing because it was an early retirement scenario. So it's fluid. It's very dependent on when you want tax now or tax later, those three phases of life, while I'm working, while I'm retired, while I'm dead, mapping those together. And I have to say this, there's still hope. Behind the Roth IRA, we could have the Justin IRA. Do you know where this name comes from? I wanted to make sure we said this at some point. Does anybody know why we call it a Roth?
Let me. Was it this? I'm just guessing. Was it a senator that sort of passed the legislation or something like that?
Yes. So Delaware, everyone's favorite state, Delaware Senator William Roth, and it was 1998. So to your point about these haven't been around that long in this country, 1998 is when the Roth was introduced, named after Senator William Roth from Delaware. And it wasn't until 2006 that the Roth 401k option came into place, which is another reason why, to your example with the client whose RMD age, that's 25 years ago that this became an option.
Right.
How far into that person's career were they when that, let alone the Roth 401k option, even came onto the table? That's under 20 years. This is also what makes it tricky too, because a 70-year-old today has a harder time advising a 50-year-old or a 40-year-old on this out of their own experience. Maybe not a professional advisor, but like in the olden days of, where somebody at work would actually give you sage-like wisdom of making sure you're putting money aside.
So Ben, thank you for joining us again and helping us sort of understand this and walk through it. And I just got to ask, is this a new term that instead of dollar cost averaging, conversion cost averaging, CCA? Should we, or do you get full credit for that, or is that something that's known in the industry?
Kit just said something similar. Obviously somebody's going to watch this video and be like, he's a liar, he stole that. I haven't heard anybody say it that exact way, but it's time to get the trademark put on it.
There we go. I like it. First heard on the Education of a Financial Planner podcast. All right, Jen. So there's a lot going on here. The important thing is Roth IRAs are good. They can be complex. Work with a financial planner, understand your options. And we hope you guys found this conversation valuable, and we'll see you next time. Thank you. Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at @JJCarbonneau, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.